would you say that early with or no early withdrawal penalty would be an advantage?
It absolutely has to be because you want some. We talk about this. It's kind of liquidity, use, and control. We've talked about that before. So when you're talking about an early withdrawal penalty uh, with a life insurance policy, that is giving you a level of financial flexibility that the 401ks just cannot provide. So this feature not only allows for penalty-free access to cash at any age, but it also empowers that you as the policyholder to make financial decisions that align more with your immediate needs and long-term goals without that burden of unexpected penalties. So when you're talking about that type of an advantage with the life insurance policy, it's the absence of early withdrawal penalties. And this is a stark contrast when it comes to a life insurance policy versus traditional retirement accounts like a 401k. So if you're withdrawing funds from a 401k prior to the age 59 and a half, you're going to be hit with a 10% early withdrawal penalty typically. And in addition, you're going to owe income tax on the amount you withdraw. So that can be substantial. That can be a substantial financial setback, especially if you need access to your funds in an emergency type situation where you have unexpected expenses. So when you're comparing, the life insurance policy, which provides that early access to cash value without any penalties, regardless of your age, by the way, this means you can take out loans or make any type of withdrawal whenever you need it, and that gives you flexibility to tap into your accumulated cash value for various purposes, whether it's to fund education, which I've done, currently with my two oldest, purchasing a home or even covering medical expenses. So you have that freedom to manage your finances in terms of a fear of without incurring additional costs or early withdrawal penalties when it comes to a 401k. So this penalty-free access is especially beneficial for younger policyholders because those who may face financial challenges even before retirement, you want to have access and use of money without being hit with any penalties or taxation. And this cash value within these policies provides that safety net and allows you to address urgent needs without being penalized. And since these loans against the policies are not taxable, and as long as a policy is enforced and you can access these funds, and because it does not avoid I'm sorry, it avoids any triggering taxable event where anything in a 401k, any early withdrawal is going to absolutely be a penalty and or taxation.
Well, and this is huge when you think of emergency situations or the state of the economy where we're at right now with interest rates going through the roof. You've got inflation going through the roof, and life is getting more expensive. And we see it in the credit card balances. The credit card balances are through the roof right now. Savings accounts are down. And the only place people have to go to is typically going to be that retirement vehicle. Why do you think they put the 10% penalty on there for accessing the money before 59 and a half? It's because if you need it, they want a piece of your money. And that's why it's there. But people don't understand when they get into these plans, Ron, that they're actually agreeing to, number one, partner with the IRS, number two, partner with them for 30 years, 40 years until they're 59 and a half. Most people start work age at what, 20, 24? I mean, for me, it was 2021. For others, it may be 24, 25. But I mean, you're talking locking up your money. And if you want to touch it prior to the age of 59 and a half, which could be 30, 35 years for most people, and the idea that something isn't going to happen over the course of 30 to 35 years, that, hey, you may need that money for some reason. Tons of people I talk to, Ryan, they say that they cashed out their 401k to purchase a home, right? So the savings was not in their bank account, in the savings account, so they can go purchase a home. A lot of people hit 40, 45, 50 years old. They're taking a portion of their 401k to put down on a house payment. And a lot of people don't think of that when they get involved in it. Hey, this 10% penalty is going to be attached anytime I need to take money out and utilize it. So
Well, in
that's
terms of
something
that,
that we
just
don't
real
think
quick,
about.
there's just to add on to that a little bit. We don't need to get too deep into this, but there are hardship situations with 401ks that we can tackle here just a little bit. There are situations where you can take money out, and we're seeing this more and more, Will, where today, currently, because of what you just described from a savings perspective, with inflation and things of that nature, people are falling into having to take money out of 401ks as a hardship because they're shorthanded in terms of their revenue to their household. So they're tapping into these types of plans as a hardship, which can be done, and that avoids the penalty and the taxation that we were talking about. But there's rules, extreme rules attached to this. It's a loan against that plan, so you have to pay it back. You have to pay it back. If you do not pay it back within a 5-year period, they're gonna retroactively go back to when you originally took that hardship loan out, and they're gonna hit you with the taxes that are owed on that and the penalty. So it doesn't go away. So if you don't adhere to their rules on getting that hardship money back into your plan, you're going to be hit with the penalty and the tax. And the bigger factor here, in my opinion, is what you're paying back a hardship with after-tax dollars, putting it into a vehicle that is deferring tax and is going to be taxed again when you go to take the money back out again. So it's, in essence, a double taxation. So when we talk about hardship, that there is access because of the hardship, you really have to dig into. Now, granted, there's maybe you just have no other means and you have no other choice. Then that is what it is. But if there's another avenue to take, that's the last resort you want to exercise, is that type of a plan when you're talking about emergency style situation of needing access to funds because of what I just described. So that hardship, it can be real. People are dealing with it as we speak today, and they just have no other means. But you have to understand what the rule is of paying yourself back, because they're not going to let you avoid it completely. So that's something that we just need to talk about and understand, and hopefully, as a last resort, that would be what you would have to do.
Well, and I think it's important people know that going into the 401k, or if they're still early in contributing to a 401k, there are other options out here that don't penalize you for utilizing your own cash.